Hi, everyone. Welcome back to the InvestPop podcast. Today's guest, Venu Reddy. Venu is the president of FBS Securities and also the co-founder of 42 VC. Prior to launching both his own RIA and his own VC, he got a start on Wall Street, working for, sounds like the majority of the firms, BNP, JP Morgan, Lehman Brothers, and Credit Suisse. And just to add to your resume, you're now an author, out with a new book, Ultimate Guide to Cash Balance Plans. And it's so great to see you again. Of
Thank you, Cam. Thanks for having me today.
course. So, curious how you got your start in the industry, and then what led you to launching both your own VC and your own RIA.
Okay. A quick background. I am an engineering from an education perspective, and I did my MBA in international business. I was an engineer when I started my career, and I came to United States in 1999. When I came here, my first job was with JP Morgan, and I got an opportunity to work on the asset management side. And from there on, got to move to other organizations, Lehman Brothers. And when Lehman Brothers went under, got an opportunity to work with BNP Paribas, which is a French bank. I was thinking that I'll continue working in capital markets for a long time, but there are curveballs in life. My daughter had some health issues, so I relocated to Texas in 2013. And we did not have work from home option at that point in time. So I had to quit my job in 2014 and started doing some small ventures out here in Texas. Then decided to get back to investment banking, but more on the retail side. Joined a hybrid firm, Venu Securities, that is based out of Ohio, who are also a correspondent of Royal Bank of Canada, RBC. That was my first stint on the retail side, and I started enjoying advising clients. There were some compliance issues with Venu Securities simply because it had both a broker-dealer and an RIA arm. And I have my Series 7, 79, 24 principal licenses, then decided if I have to do an RIA, I don't need any of those licenses. Let me just focus on RIA. So I spoke to Robert Cargin, who was the president of Venu Securities, saying that I'm going to start my own RIA firm in Texas. And he said he was happy about it. And he said, yeah, just go ahead and do it. So in 2023, I applied for the license and we got the license in August of 23. It's been 7 quarters. We are enjoying our journey. There are 5 members in my team, 2 advisors, me and another colleague of mine by name Jane Manet. We have an in-house portfolio team. AJ is my colleague. He takes care of all the portfolios, both equity. We do structured notes, equity investments, and fixed income trading in-house. And I'm supported by another colleague of mine by name Suchana, who takes care of retirement portion of it, and also financial planning. And last but not the least, I have a young person who has joined us. She is a computer science professional and helping us with artificial intelligence, AI, stitching all the various products like InvestiPal on the AI side and making us more efficient. On the 42 VC, so the venture capital is entirely different from the RIA space. That's a fund business, a private equity early stage investments. I had a colleague of mine who wanted to start a fund, and the thesis was to invest into SaaS-based companies. I found that there was a gap, especially in the early stage companies, SaaS tech for Indian founders looking to expand into United States market. So the thesis was primarily adding value for products that are built in India, but the market is in the United States. So again, starting a fund has its own complexities. 1940 Investment Company Act, whether it's a 3C1 or a 3C7 fund. So that's how I got into VC, and we are doing good on that space. We have invested in 10 odd portfolio companies. Yes, that's my background. Yeah.
Very extensive. So you got your start with the capital markets business and then had to dip your toes in the entrepreneurial world. Very interesting. especially stuff you guys are doing on AI, because a lot of firms we deal with are trying to think about it but haven't yet applied it. So interesting, just in terms of the skill sets on the team. Switching gears over to the new book, because this is an area I'm not as familiar with. I mean, as a Canadian as well, just getting the flavor of the U.S. Retirement landscape. I know that's a key pillar within FBS, but could you talk a little bit about the new book and what exactly a cash balance plan is and how it would end up comparing against like a more traditional 401k or DB, DC pension plan?
Sure. Cash balance plan. Think of it as a retirement plan on steroids. It's designed to turbocharge savings, especially for high earners using pre-tax dollars. Now, when I just look at my profession, financial advisor, my job is to advise. Whom do I advise? I advise to individuals, small business owners, or professionals. Now, when it comes to small business owners, employee benefit is a key component of it. And the owners also want to save a lot of money for themselves during the retirement age. And when we talk about small businesses, especially in the field of, let's say, medicine, physicians or dentists or lawyers or CPAs, by the time they finish their education, pay off their debt, and are stabilized, they are almost in their late 40s or early 40s to late 40s. Now, when it comes to retirement, if we just look at the traditional defined contribution or DC plan, we have an annual limit as to how much a person can contribute. And the limit is annual. For example, for 2025, it is $70,000 if you're under 50 and you have a catch up for $7,500. But that's again broken down to your earned income and what an employer can contribute, either in terms of match or profit sharing. But this limit resets every year. If I don't contribute in 25, I can contribute in 26, and that's how it works. But when it comes to DB plan or defined benefit plan, we have a lifetime limit. There is no annual limit, but a lifetime limit based on the benefit an individual can get. Let's take in this particular instance, I am a small business owner and I want to have a pension. According to IRAs regulations, I can earn up to $285,000 annually as of today's date if I retire, and the retirement age could be 62 or 65. So what it technically means is I can contribute a lot more money based on my age and income, and this is tax deferred. So that's the reason I say this is retirement plan on steroids, cash balance plan.
Interesting. So would it be, when you talk about business owners, is it for the business owners to provide to their employees, or is it a retirement structure for that business owner when they end up selling off their business in the future?
So it works both ways. Primarily, if I just look at small businesses, cash balance plan typically, where in my experience, work for businesses between 1 to 10 employees. If I'm a solo owner or a solopreneur, I can have a combination of a 401k plan and a defined benefit plan, preferably a cash balance plan, and I can maximize my savings. Now, if I have employees, I cannot discriminate, obviously. So again, against the rank and file. So there are a set of rules that needs to be taken care of. So what happens in small organizations, let's say a physician or a dental office or a real estate office, you have a small core team. And if you can take care of your employees, your business obviously grow, because happy employees, happy staff is always good for the business. But as a business owner, you don't have to contribute too much for your staff. So the way we have seen it being structured as a 401k or a DC plan is set up with a safe harbor. Let's say I'm contributing 3% to my employees, and then if I contribute an additional 4 or 5% as a profit sharing or a DB plan, that will satisfy. So technically, if I'm saving, let's say $300,000 towards my retirement, I might be contributing under 10% to my employees. and majority of the money to myself for my retirement. So for small businesses, it works really well. But where it starts getting a bit more complicated is when you have larger employees and you have, as a business owner, you're a younger person and you have older employees, then things don't work in terms of discrimination testing, because this is a benefit that needs to be provided by the employer, and their things stop working.
Interesting. Okay. It would be helpful for me to get like a comparison maybe on like when do you think I know you mentioned the company size being one factor, but is there any other sort of considerations between like a 401k or cash benefit plan?
Yeah. I'll take a scenario. Let's say I have this young business owner who is an entrepreneur, starts off his career in late 30s. I would recommend him to just stick with a DC plan, a 401k for himself, because there is an annual limit, and build your 401k. As he is closer to, let's say, late 40s or early 50s, he can start adding a defined benefit plan, because in defined benefit plan, there is a lifetime limit. There is no annual limit. So there is no advantage for me to start early. I can as well start late. The major difference is when I look at a 401k plan, it's a contribution. So the risk on the performance of asset primarily relies on the participant. In this particular instance, either the business owner or employee, because it's their account. It's a separate account. And the risk for investment is primarily the investments that they choose. But in defined benefit, it's a pooled account. We don't have a separate sub-account for each individual. From record keeping, we do categorize the money separately, but it is still one account. And the money that gets into this DB plan is, there are two streams of money. One we call as a payroll credit. Another one we call as an interest credit. So payroll credit is whatever is the payroll, a percentage of payroll, or a fixed sum of money gets sent. And once the money is in the account, there is an interest the actuary would have determined based on the plan, saying that this particular plan should have an interest rate of approximately, let's say, 5%. Now, if I'm a young entrepreneur, I wouldn't want to start the combo plan or a DB plan early in my career, but I can do later in my career. On the other hand, let's say I have a business exit and I have a windfall profit and I choose to use that, then I can choose to save money through a DB plan by having a huge contribution. That's also possible.
Interesting. Okay, so like a tax mitigation strategy if there is.
Yeah.
Okay. And then in terms of, so maybe not for like the employee, but for that like solopreneur you mentioned, would it be first like maxing out your IRA and then anything additional could go towards a CPP or 401k? Or would you think about it a little bit more nuanced than that?
So for a solopreneur, I would suggest that if you're looking at an IRA versus 401k, it's an earned income, obviously. If my income is above $150,000, $200,000, I recommend them to go for a solo K, because their contribution as an employee is $23,000. It was $23,000 for 24, and I believe it should be $24,000 for 25. And as a solopreneur, you can also do an employer match, which is 25% of your earnings, up to a max of $46,000, because the sum cannot exceed 70, 69 for 24, and I think 70 for 25. When it comes to IRA, the limits are much lower. $7,000 is the limit. And so we wouldn't recommend IRA if you're a high earning individual. When is it a good idea to add a cash balance plan is if you're earning above $300,000. Because I have to exhaust my annual limit, that is $70,000. And if I take a 25% average profit sharing plan, so up to $200,000, I can exhaust my 401k plan. It doesn't make sense for a person to spend additional money for compliance and actuary and start a cash balance plan if the earning is under $300,000. Anything above $300,000, you're in the topmost tax bracket. You're in 37% federal tax bracket, and if you're in a state like California, state tax, our taxes could be above 45, 50, close to 50%. Now, any money that you earn, 50% goes to the taxes. Now, it is prudent, and this is a great strategy at that point in time, to defer the taxes, invest into your own retirement, and this money doesn't have volatility like the markets. So this is a good diversification strategy because it grows gradually at a 5% credit with tax deferred. So it's a fantastic strategy for someone who is earning $300,000 and above, using 401k for investing in the markets and CBP for having a upward trajectory and a stabilized growth.
Got it. Okay. Very interesting. And then for any advisors listening to this, how do you think introducing this sort of strategy could help their clients, and if they're running that RIA, the relationships they have with those clients?
So any financial advisor, the biggest challenge offering a retirement solutions are twofold. The first one is the third-party administration, or a 316 fiduciary according to ERISA regulations. Because as a financial advisor, I am bound by SEC regulations. Now, when we start introducing retirement solutions, I'm also bound by Department of Labor regulations, ERISA, Employer Retirement Income Security Act, which was enacted in 1974. So the 316 fiduciary is primarily for the trustee. The trustee is generally the sponsor. The sponsor is typically the business owner who is sponsoring the retirement plan. When somebody wants to sponsor a retirement plan, they technically need 3 documents. One is a trust agreement. Number 2 is a plan adoption agreement and a summary plan document. These are for the employer or the company, and then the participant forms. The financial advisor should either partner with a third-party administrator to take care of the TPA work. And now comes the second piece of the challenge, which is record keeping, providing access to participants, because participants want to sign in, they want to be educated about retirement, they have to make the right investment choices. So that's the second piece of it. And there are large organizations like Empower, Matrix, who provide software for financial advisors, and they can use those solutions. But then that usually typically come with something known as a 321 investment selection, which is a set of funds that I can enable to my participants to invest. But as a financial advisor, you can also do a 338, which means you're advising the participants, and you get to earn a bit higher fee because you're providing a real value-added service here. If you just look at the funds in 321, that is an ERISA regulation, most of the funds are conservative in nature, unless or based on indexes. So by using the 338, they can provide advice. The way we look at it is, any financial advisor who wants to get into a retirement solution, if they want to collaborate or partner, if they want to partner with a firm like ours, FBS Securities, we can be their back office because we are an RIA firm. We understand how the advisory business works, but we also have deep intellect knowledge on the retirement space when it comes to compliance, regulation, actuary, filing of Form 5500, educating the participants, the whole gamut of it. So to rephrase, any financial advisor looking at providing a retirement solution, if they have access to small business owners, profitable small business owners, this is a good way of getting their AUM. That's my answer. Yeah.
That's very interesting, especially, the folks we chat with, we offer planning, we might offer like estates or like tax, but I rarely have ever heard them offer like actual retirement solutions like this before. So that's super interesting. Final question, maybe just to put a bow on it as well. I know you mentioned, the 300K limits and like the audience. Do you have any examples of like a case where, first of all, this went well with like one of those professionals or business owners, and then conversely, like a case study on when this did not go so well with someone?
Yeah, I'll take two case studies. One is that went well and one that did not go well. I have a physician, and as physicians, we understand that they are also liable for lawsuit. It's very important for them to protect their assets. How do you protect your assets if it's in a trust, especially in an irrevocable trust? So retirement trust is one of the trusts which is not accessible to the creditors. Now, as a physician, we recommended this particular client to set up a retirement trust for 401k and a separate retirement trust for cash balance plan. And they had a small staff. We got the census data. We just looked at the income for this particular physician's office. It was in terms of $1 million, and they were paying a lot of money in taxes. So we suggested them that they could invest in cash balance plan and also provide retirement benefit for their staff. The physician was very interested, and we set up the plan. So when we set up the plan for this particular physician, we just looked at the historic cash flow, and we also wanted to make sure that ongoing they have sufficient cash flow to take care of the obligations of CBP. You should not start a cash balance plan if you do not want to continue at the least for 3 to 5 years. At that point in time, if you want to stop, you can stop and roll over the money to IRA and still continue to grow the way the business owner wants the money to grow. So for this particular physician, she is 48-year-old, started the plan 2 years ago, a year and a half ago, and it's going really well. They are contributing close to $400,000 per annum. That is a direct tax savings of around $175,000 per annum for the physician. And the money is growing, and they have an interest crediting of 5%. And today, high rate interest environment, that's not an issue. So the money automatically grows. That is not an issue. But in a low interest rate environment, that could become a set of challenge. But that's where a good financial advice come into play. You could invest in certain products that can give you a range of return between 4 to 6%. Now, there is a scenario where it did not go down well. There was a client who came to our office last year. She was earning $1 million annual income. She went to her CPA, and her CPA recommended her. She is in her late 50s, 59, almost eligible for retirement. And they got this cash balance product done through an insurance firm. The client paid for 2 years, contributed for 2 years, and then the income stopped. And the client assumed that she had contributed $600,000, $300,000 annually to the plan, and she wanted to terminate the plan because it was an insurance product. The cash value was a lot lesser than what she contributed. And the narrative the CPA had provided was entirely incorrect than what plan she had gotten herself into. Now, this cash balance plan is a complex product. She asked me to get involved. I spoke to the CPA, spoke to the insurance company, and then tried to educate the client that she has signed all the paperwork. Unfortunately, now there is nothing much that can be done. But she could move her money and roll it over into an IRA. And that's what she did. She rolled it over into an IRA and transferred the asset to my firm for us to manage. And the lesson that I learned over here was that the CPA, he was a CPA for this client for almost 5 or 7 years and earning between $7,000 to $10,000 as a tax advisor. And he lost this client simply because he sold a product without understanding the risks involved or the complexities involved. And he did not understand the product. Neither the client understood the product.
Interesting.
So, yeah.
What type of product did the insurance company offer? Was it a CPP or was it like a different
Tax
special?
balance plan.
It was, eh?
Yeah, it was. For example, now when we look at any retirement offering scam, it's very interesting to learn that a qualified plan, according to IRS regulation, is it can grow tax deferred and the distribution is taxable. It is not taxable if it's a Roth, but if not, it is taxable. Now, the other way of looking at it is if I invest a money in insurance company or an insurance product, it is also a qualified account because it grows tax deferred and distributions are taxable depending on how you structure it. If I'm investing qualified money into another qualified account, it is meaningless in my viewpoint because insurance products in general, there is a lot more commissions involved. And I'm not saying it is wrong or incorrect. It might not be appropriate for certain clients and clients who want more security, who do not, who want annuitized income. It's a fantastic product. So when CPAs do not understand and they just sell a product because they have some relationship, that runs into some challenges of them losing a client.
Yeah, of course. Okay, very interesting. But maybe we'll leave it there. If anyone is interested in learning more about CPPs, whether they are investors or people off the street looking for an advisor towards this, or an advisor looking for a third-party manager, where's the best place they can connect with you?
My email ID is the best way to reach out to me, and I'll also give my cell phone number. My email ID is V as in Victor, R as in Red, at FBS Frank Boy Sam Group GROUP.co. I'll repeat, it is VR at fbsgroup.co. And my cell phone number is 212-203-3302. And that's the best way to reach me.
Okay, wonderful. And we'll leave a link to your email and to your website as well in the show notes for anyone interested. Hopefully there's no spam callers that hit you up now. And thank you so much for coming on tonight.
Cam, thank you. It was my pleasure being part of your podcast.